Okay, I think I'm all set up. Let's go ahead and get started. It's 5:30. We got a lot of material to have to get through, so we got to get here on time. So the examiner is still which means that tonight's lecture won't actually be tested until 4 weeks from, right? Well, guessing I'll do the first exam or probably be sitting in class exam for the evening. That's like probably good. I haven't looked at any of the scores yet, so I don't have anything on that for you. Questions on homework, research project, exam. There's some lines. We got last two classes, we'll have like workshops. Yeah, I used to teach this class of comprehensive final exam, and the people that is overwhelmed 2 months at the end of the year, both the comprehensive final and worked it amount to 60 degrees. So I did away with comprehensive exam. We just have 3 leading up to that, and then the final 25% of the class, which would be nice 13, 14, 15, 16. That's just open to the workout time. So we'll show up. The homework is still out there on my different courses, so those points are available to you. And I might spend a little bit of time lecturing on that material just so that you understand what might be asked of you on homework and how to apply it to the research report, but it will not be tested. So that really freed up a lot of time to focus on that research report and seem to work a lot better.
The one is the last time.
Yeah. Yeah. So questions and I'll try to help out as best I can.
The format of the, or the, one thing that the sample. Right. There's a couple of the template, all that template.
Yeah, all of that template, that's a requirement because I need that to grade all of these research reports at the end of this stuff. So I have to sit down with however many reports between 20 and 30, and I have to get them all graded within, it's usually a weekend. So I really, and focus on that cover page. I want to format it just like that, so I know where to go to review the 4 M's of that framework: management, growth, business, pricing, and market. I really get thoughts on that. I want you to have a very tight conclusion or the recommendation. I'm going to read the risks, and then I'm going to read the first 10 to 12 pages should be your executive summary with all of the absolute most salient points supporting your conclusion. And then everything beyond 10 or 12 pages is an appendix that really that's you exhibiting to me that you know how to do the work as it pertains to all of the modules that we've covered this semester. So just chunk that out module by module, and I understand that all modules won't be relevant. So let's say tonight we're talking about consolidated accounting. So if your business doesn't own all or parts of another business, then they won't have any consolidated accounting. And that section of your report is going to be not happening. So all I need to see is that you reserved a section for it and that you told me there's no variable interest entities. That's one of the terms we're going to be learning when talking about it. There's no variable interest entities to consolidate, and therefore this conflict was not happening. For some of you, that won't be the case. You'll have 5 or 6 variable interest entities that affect your accounting, and I'm going to expect that you have gone a little bit deeper to explain how that affects your research report, accounting, and then I'm going to be looking for any explanation of whether or not you needed to adjust the forecast, the financials, or the ratio analysis relative to peer group and or historical, if you have mergers and acquisitions, activity effect and different time period. So we're going to look at an example of that. So say last year, you were operating as the company always had, and this year you bought another company, merged it in, those two time periods are no longer comparable. So in order to draw any meaningful conclusions or trend analysis, you have to go back through time and adjust all those numbers. Fortunately, your management team pretty much done it for you, and you can go into the work for back that are a lot of different places. Full off the adjusted. Okay, if you think of anything else, just interrupt me as we go. Tonight, we're gonna be talking about, module, I think this is module 9. Yeah, file shows module 9. So I mentioned variable interest entities, that's, a key piece of terminology that just means that one company called Company A has bought all or a part of Company B, and then Company B becomes the variable interest entity. And there's several ways that we account for a variable interest entity. We're gonna look at 3 of them tonight. One of them is very self-explanatory, and then the other 2 have some nuances associated with them that might cause you to make some reconciling entries as the financial analyst, so that you can use that historical data. And then our authors threw in a couple of odds and ends at the end of this chapter that we'll touch on briefly. But first off, let's talk about, enlarge this. There's dozens, if not hundreds of reasons why Company A might buy all or part of Company B. Our authors give us a handful of them here that include strategic alliances, targeted projects, market penetration, short-term investment of excess cash. One of the most common reasons that I see tied all the way back to module 1, when we got together for the first time, what incentivizes your management teams? Well, very often, management teams are incentivized to grow revenue. And one of the easiest ways to grow revenue is go out, buy another company, and you're gonna have to consolidate those financial statements, and you just know the revenues. Well, I don't like it, because I don't view spending money as a skill. If spending money were a skill, then we would pay these CEOs, and they were funded. But in my view, that's not a good use of performance-based incentive systems to link something to revenues or earnings, if it can be accomplished through inorganic growth. Because think about what you've just done there. If you incentivize somebody to grow earnings into revenues, and it's okay for them to do it through inorganic growth, that's an organic thing. Organic is just go out and get your customers, through animal, but inorganic is murder. So if that's okay, then you are fundamentally distorting the price that is fair for the acquired business. Because the management team is going to be incented to overpay and therefore destroy shareholder value. And in the process of destroying shareholder value, they're going to line their own pocket because they're going to trigger that incentive-based comp. So this is something to be wary of. And again, one of the reasons why we play this little game of follow the penny, know how your management team gets paid, understand their incentives, and you're going to look at a lot of these transactions through a different lens. So these are the 3 ways that we account for Company A buying Company B. We're going to look at level of control. If the company has control, so call that greater than 50% of the outstanding shares, that would be control, then we're going to use consolidated accounting. That's the bottom there. And consolidated accounting takes all the revenues from Company A and all the revenues from Company B and puts them onto one income statement. Do the same thing with balance sheet. Take all the assets from Company A and all the assets from Company B and put them onto one balance sheet. There's a couple of reconciling entries that we're going to look at tonight, and that will result in a minority interest line item, which we've touched on several times this semester. We're going to review that. If you do not have control, so that's the top half of that graphic, no control, then we're going to look at the level of influence. If we have no influence, easy peasy. we're just gonna account for it as an investment. So we buy a few shares from Apple, Apple shows up on our, balance sheet as an asset. The, cash goes out the door, that decreases on our, balance sheet, and the investing activity goes up on the statement of cash flows. And then at the end of every quarter, when we publish new financial statements, we're gonna mark that to market, meaning we're gonna adjust the value of that investment up and down based on how the stock price has moved. And if we have a gain, we'll run that through the income statement, and if we have a loss, we'll run that through the income statement. So just think of that as the most straightforward accounting of any investment where we have no control. If we have significant influence, and significant should sound very subjective because it is subjective, then we're gonna record this investment as if we were an equity stakeholder. And that gets a little bit confusing because we're actually gonna book the income of the other company on our income statement in the proportion that we own. So if we only own 20% of the other business, we're gonna take 20% of their income and increase the value of that holding on our balance sheet. It doesn't fluctuate with the stock price of the investment. It fluctuates with the earnings of the investment. That's called the equity method. We're gonna look at that too. So the equity method is a little counterintuitive. We'll try to take that one systematically. And then there's some nuances to the consolidated accounting. But the little or no influence we call passive investing, and that's a piece of cake. Let me skip to slide number 7 here. Star this page. This is a good table. It shows you the kind of puts all the nuances and stuff. These are the different accounting figures from one table or 50 on that table on the test. So definitely come back to this one. We want to know how each of these accounting methodologies is reflected on the balance sheet, income statement, and statement of cash flows. So just like I mentioned, the fair value method in the top row there, pretty simple. The equity method. So the investment account equals the percent owned of the investee's company. So 20, 30, 40%, that's how much of the investment is going to be on the balance sheet. This first one, again, a little counterintuitive. Dividends reduce the investment account. Why would, if we're company A and we just bought company B and company B issues a dividend, which means they're sending us cash, why would that decrease our investment? When the investment account shows up on our balance sheet, we own 20% of the company. In round numbers, let's say it's $1 million company, so we initially put it for a $200,000 investment in company B. Now company B issues us a dividend, and we're going to reduce the value of that investment account. Yeah, it's counterintuitive. We need to think of it as an owner. So if we own company B, we own 20% of company B. If we own 100% of it and they issue a dividend, that would have been us sending the cash out our front door to other investors. So that's how we think about it under the equity method of accounting. We think about it as if we were owners, and owners pay dividends. Owners don't receive dividends. Conversely, on the other side of that coin, all of the earnings that they make and keep, we're going to reflect as an increase in the value of that investment. So if the investor reports income equal to the percent owned of the investee, company B, income. And then we'll get into that in a little bit more detail. That's the most confusing part of this whole lecture, is that equity method of accounting and how dividends are reported one way and income is reported another way. Okay, let's talk about the fair value method of accounting first. Pretty simple, like I mentioned, but there are some subtleties to it, because when we have little influence at the end of the quarter, we're just going to adjust the value of that position on our books If it's Apple, then it's not. Okay, but what if it's not Apple? What if it's something more imitated or something that we don't have day to day or minute to minute prices or something? What if it's private investment? Well, then we get into this concept called level 1, level 2, or level 3 quotes. And FASB identifies these for the benefit of investors, so investors can know, well, just how certain am I, so how certain are we as investors in the value that that company is reporting on their balance. This gets into some murky waters a little bit, because we made an investment in a private company. Well, it's not publicly traded, so we don't know what it's worth like we would if it were a publicly traded company and then of course. So we're gonna have to make estimates. And anytime we make estimates, we're introducing the likelihood for gamesmanship and shenanigans. So level 1, quoted markets, easy. Level 2, quoted markets, but it's not as simple as a direct stock. So you might think like a mutual fund or some other gentleman farm that doesn't trade every day, or we have to dig just a little bit deeper, but you can put a lot of confidence in both level 1 and level 2 quotes. Level 3 is where it gets a little bit more confusing because we have unobservable inputs. This might be, we might engage a third party to do an analysis or an assessment on what a business is worth. We might look to comps in the marketplace or other businesses that have recently sold at similar values with other similar businesses that have recently sold that we can draw inferences from and then kind of triangulate in on a value. If this is material, then when we get to module 9 of your research reports, I'm going to want to see that you went deep on the level 3 unobservable inputs that determine the value of that asset on the balance sheet. Just how subjective is that investment?
So companies not like separate their parent companies operate, something like other revenue, so like when they on the balance sheet, look and say they have X amount of cash or revenue coming in, and you could just look up like they're operating, financing, investing, cash flows for that period. Figure out what value is again.
I don't want to get ahead of ourselves here. I think the answer to your question is yes. For the purposes of just this slide, we're talking about purchasing companies where we have no influence whatsoever. This is the fair value method of accounting. And we have so little influence, we own so little of that company, it wouldn't make sense to consolidate the business. So, okay. It's likely, because we own so little, to be insignificant. And if it's insignificant or immaterial, we can discard it. Now, validate that, because if you have a small business and they own 1% of Apple, well, 1% of Apple for most businesses is pretty darn significant. But just be mindful of it. And then when we get to here in a few slides, we're going to talk about consolidated accounting, and we absolutely will make some reconciliations to get all that on one set of books. So bear with me here just a minute. This is how you're likely to see it. This is Alphabet's balance sheet of 2002. They have cash and cash equivalents. So cash equivalents would include money market funds, and money market funds might have a level 2 quote associated with them. There's no ambiguity in the level 2 quote associated with money market funds, so you can take that number at face value. Marketable securities, those would be other stocks and bonds. They're listed under current assets. So that means that they have to come due within the next year. So those are probably bonds and other commercial paper assets. And then the non-marketable securities would be private equity, maybe some private credit, other one-off investments in competitors, other businesses. And those are probably going to be level 3 quotes that require an added layer of due diligence on our part as the analyst. Okay, let's look at debt securities here real quick. And again, we're still within the fair value method. At the end of the quarter, when we're using the fair value method, we have little influence. So we have little influence equals fair value. Little influence, fair value. Those two go together. We just looked at the accounting for equities. If we're using the fair value accounting method, and we have debt securities that we're looking at. We have three classifications. If it's held to maturity, we're gonna make the assumption that we're gonna, well, it is what it's exactly what it sounds like. Those bonds are gonna be held to maturity. And because we're holding them to maturity, FASB gives us an opportunity to just leave them at the historical high. If we buy a bond for $1,000 and it go up or it go down, otherwise cause the price of that bond to move, we don't have to mind for them. If it's staying on the books at 1,000. That's in held to maturity. Yeah. Now, if it's a trading security, then at the end of the period, we're gonna look at the change in the market value of that bond. And we're gonna look at gain or loss, and that gain or loss is gonna flow through to net. If it's an available for sale security, which is a debt security that may be sold prior to their scheduled maturities to meet liquidity needs or risk management objectives. So it's contrast that to a trading security with debt securities that are held for a short period of time and are intended to be actively traded. So this is the key word, intended. What is the intent? That sounded about as ambiguous as anything else that we focused on this semester? Yeah, because you can change your intent just like that. Okay. But that's what the language says. So depending on management's intent, we will either mark to market these securities, book a gain or loss at the end of the quarter, if they're trading. If they're available for sale, we will book a gain or a loss at the end of the quarter and put that through other comprehensive income. Last week, we talked about the base, or like always jump, these are gains or losses that accrue in a handful of different pockets of the accounting system. That we don't want to run through net income because we would otherwise distort our premium. Well, this is one of those pockets, available for sale securities. So if you're looking at the accounting system with a skeptical eye and you see a big loss on a bunch of bond securities, or maybe you're the CFO of a company and you see a big loss on a bunch of bond securities that we have on the balance sheet. And last quarter, you had them classified as trading securities, and you're like, ouch. That's gonna run right through net income if I leave them as trading securities. Well, maybe you change your mind or change your intent and relabel them. So this quarter, they're not trading securities anymore. This quarter, they're available for sale securities. Well, as soon as you do that, you don't have to run that loss through net income anymore. Now you can run that loss through another comprehensive income. And you're doing absolutely nothing with the fundamental underlying economics of the business, but you're window dressing the account in a way that's more palatable to investors and other rookie analysts that are just gonna see the headline when it crosses the line. Because the headline is always gonna be net income divided by total share account equals earnings per share. And if your management compensation package is linked to earnings per share, that might also allow them to get themselves paid. Talked about all that. Okay. When a company sells available for sale securities, there's a gain or a loss embedded in other comprehensive. if it's available, if it's classified as available for sale security, and a reporter will look in Indiana law, and it shows up, then other comprehensive income, but it's unrealized. When we decide to sell that security, that gain or loss becomes real. Now it's real. It's not a paper gain or loss anymore. It's a real gain or loss. And at that point in time, we don't have any choice but to reclassify that and bring that gain or loss out of other comprehensive income, and we actually post it to the top of the income statement. We see that gain or loss reclassified within net income. So here we're looking at Alphabet's consolidated statement of comprehensive income. So we have net income as it otherwise would have been reported, other comprehensive loss, fast forward down to less the reclassification adjustment for the net gains and or losses included in net income. That's $1,000 due to the sale of a bond that previously had a deferred gain associated with it, embedded within that other comprehensive income. Key piece of terminology there is reclassified, because that does happen. Okay, let's move on. That was all fair value accounting, little to no influence. Now let's move on to equity method of accounting, which is significant influence. Okay. What is significant influence? We already identified that if we own 50% or more, that's control. Okay, that's easy. Control equals consolidated accounting. But now we're in this significant influence. Okay, what is that? As a general rule of thumb, if you're between 20 and 50, that's significant influence. But it doesn't happen. And you're going to see all sorts of examples of different companies that, let's say Berkshire.
The other 20% will still be.
And the other 20% still have significant influence. That's all based on, again, it's subjective, but you're going to base that on the concentration of the shareholder base. You're going to base it on the number of seats that you might have on the board of board of directors. You're going to base that on other contractual relationships that you might have with the supply chain or other, global distribution agreements. All of these things add influence, and it's the totality of everything that comes into that equation that determines whether or not if you can use the equity method or you use the fair value. And it's management's call. Management gets to say, we think we have significant influence. Now, the auditors might come in and say, justify that, and then you got to make your case. But ultimately, it's management's call. As the auditor, if you make the case and the auditors say, no, we don't believe it, that's not a strong enough case, then they'll issue a qualified opinion, and nobody wants that. So it's this little dance that management does with the auditors when that time comes. But most of the time, management gives their way, because at the end of the day, they pay the auditor's fee. So the auditor is always inclined to do what the management team wants done if it's in the realm of reasonableness, because otherwise they risk getting themselves fired. Now it's a black eye on the management team if they go through too many successful auditors, but they have the power. Okay, our authors give us some more examples of how you might accrue influence might become significant. The last three bullet points are pretty good. An investor company is able to gain a seat on the board, so that's influence. They control technical know-hows or patents, so that's influence. An investor is able to exert significant influence by virtue of legal contracts. So again, all very subjective. For the purposes of this class, you just need to know it's subjective. It's up to management, and the general rule is between 20 and 50%. Now, control can also be subjective. You can control a company with less than 50%. You can control a company with 1%. this was years ago, but I used to own a company on behalf of a client called IDT Technology. And IDT was, originally founded by, I forget his name, genius entrepreneur at a Midas touch in all things business related. But when it came time for him to raise funds, he did an IPO, but he structured the IPO with two share classes, a voting share class and a non-voting share class, which allowed him to maintain control of the voting share class while only having, say, 8 or 9% of the total shares outstanding. So in that instance, he would have controlled the firm, and with any similar circumstance, if consolidated accounting were necessary, you would consolidate both entities, because technically you would have control with only an 8 or 9% stake. So that can be just as subjective. Okay, here's the 5 key components of the equity method. I thought this slide was worth a star or earmark, or you might want to be able to come back to this one just to refresh your memory in 4 weeks when all this material becomes testable. So these bullet points right here under the equity method are pretty good. Bullet point number 1, investments are reported at their purchase cost. Follow the gap. I always advise you to follow the gap first, because they're going to help you. Dividends received reduce the value of that investment. So that's where it gets a little tricky. Dividends are not reported as income. Well, point number 3, the investor reports income equal to its percentage share of the investee's reported net income. And then number 4, that investment account is increased by that income. So first we report the income, and then we mark up the value of the investment by the same amount or loss for that matter. And that changes the fair value, or changes in the fair value are not reflected in the investment's carrying cost. And what that means is that it doesn't matter if the stock doubled or tripled in that quarter. The value of that investment doubled or tripled. The only thing that's going to affect the value on our balance sheet with the income that they create. Now, the income don't triple, so yes, we get the book then, but it's only relative to the income. And that's the real difference between the fair value method and the equity method. Just go down to brass tacks. Okay, let's look at the equity method here on slide number 26. Here's an example. Assume Google acquires a 30% interest in Mattel, I don't remember that one, for $300. Mattel's balance sheet reports $1,000 of equity. Google purchased a 30% stake, giving it the ability to exert significant influence. So right there, that speaks about the point. Mattel reports profits of $100 and pays $20 in dividends to shareholders, which would equal 6 dividends. So we have 3 transactions here. The first one is the purchase of 30%. So let's identify the cash. We have a credit to cash of $300 and an investment in Mattel for $300. Pretty simple. Transaction number 2, Mattel reports $100 in income. Google's share is 30. So we're gonna debit the investment in Mattel. So the investment in Mattel just went from a carrying value of 300 to 330. And then we're gonna debit retained earnings for $30. Next transaction, Mattel pays $20 in cash dividends, so $6 of that goes to Google. We have a debit of cash for $6, and then we're going to reduce the carrying value of our investment in Mattel by $6, resulting in a net carrying value at the end of the period of $324. Hopefully that adds a little bit of clarity on how that all comes about. Okay, and then as you would expect, this second bullet point on this slide
informs the financial analyst on how we might need to make some adjustments, given what we just observed with the accounting for the equity. So return on equity remains relatively unchanged when we're using the equity method, but our net operating profit margin, so if we look at net operating profit margin, most analysts include equity income and NOPAT because it relates to operating investments, but sales are not included in net operating profit margin. So you're gonna get an overstatement. With regard to net operating asset turnover, we have some movements going on in both the numerator and the denominator, so that's gonna be a little bit indeterminate. And then financial leverage is gonna be understated when we use the equity method, and this is relative to consolidated accounting. So if you have company A that has purchased several variable income entities and using that equity method, trying to compare that to company B, then these ratios are not necessarily going to be apples to apples. So these are great test questions. These are great conceptual questions. Highlight that section, come back to it. Know how that accounting is going to influence the financial statements in general, but then also the ratios that come out of that. Okay, moving on, let's talk about accounting for investments with control. Now we're over 50% and we're going to consolidate our financial statements. So conceptually, high level, thinking about this phenomenon of simplicity, we're going to line up income statements and we're going to line up the balance sheets. Then we're just going to go company A plus company B equals consolidated revenues plus revenues equals consolidated revenues. Assets plus assets equals consolidated assets. Liabilities plus liabilities equals consolidated liabilities. Now, at the end of the day, we know that's a consolidated picture of both companies, but that consolidated picture of both companies is not reality because those companies are not 100% consolidated. They're over 50% consolidated. We only own 50%. We only have control. Over 50%, but we just add 100% of both companies to get consolidated. Next, because of the so you have to make a reconciling end. That reconciling end is something that we call minority interest. So we're gonna show you how that ends up on the income statement and on the balance sheet. Here's slide 31 that identifies that terminology that I've mentioned, variable interest entity. And it's nothing more than just the acquired company. Okay, best way to get at this is to look at an example. Penman Company acquires 100% of Nissan Company. Purchase price is $3,000, equal to the book value of Nissan. That simplifies this example because it's book value. During the next year, Nissan earned $400, bringing its retained earnings to $1,400. On its balance sheet, Penman accounts for the investment in Nissan using the equity method. Okay. GAAP requires consolidation when Penman reports financial statements. This involves summing the balance sheet and income statement. Okay, so this bullet point right here. On its balance sheet, Penman accounts for the investment in Nissan using the equity method. I find that bullet point very confusing because we're talking about consolidated accounting. Now, what everybody in the room recognizes that even though GAAP requires reporting to the public consolidated numbers, both of these companies are keeping their own numbers. Like if you're employed as the chief financial officer for Nissan, you got a set of books just for Nissan. If you're employed as the chief financial officer for Penman, you got a set of books just for Penman. Now the public doesn't get to see those books, but Penman keeps those books. And when they prepare them internally, they're using equity because they have to keep track of that investment. When the auditors come in and work with the parent company to consolidate all this for public dissemination, it becomes a consolidated accounting of both companies. Let's look at how that comes together. So for Penman, we have an investment in Nissan that has been accounted for using the equity method. We just talked about the equity method. Nissan is the smaller company, so they just have what you think of as normal books. We have to smush both of those together to get consolidated numbers. And when we do so, there are certain reconciling entries that we have to make because they're just not gonna make sense unless we make the entry. So let's go through line item by line. Current assets. 6,000 plus 1,400 equals 7,400. We're just adding those together. Investment in Nissan. Well, Penman has an investment in Nissan at 3,400. Nissan obviously doesn't have an investment in itself. When we consolidate those accountings, it doesn't make any sense to keep the investment in Nissan. That just goes away. So now Nissan's fully owned. Right here, this column, that's just, we just delete that. We just make a reconciling entry. And you can see everything just adds together again. A plus B equals C until you get down to contributed capital. Penman has $10,000 in contributed capital. Nissan has $2,000 in contributed capital, but the equity method accounts for the investment in Nissan. So when we consolidate that, we have to make reconciling entry that does away with Nissan's $2,000 in contributed capital. Same way for retained earnings, functions just like contributed capital, so that goes away. Everything else is basically added together until you get down to equity income from investment, which Penman had recorded a $400 income from Nissan. That's got to go away because Nissan's net income is fully reported right here as $400. So that gets added to the net income and you have consolidated account. Let's muddy the waters a little bit. That last example assumed that Penman owned 100% of this. In this example, let's assume they only own 80%. And 20% that they don't own is going to be attributed to that non-controlling interest that I keep talking about. And same way with the income. So 20% of equity and 20% of the income both are going to be attributed to non-controlling interest. So we go through the same process. A plus B equals C with the exact same reconciling entries. Only now, when we get down to the bottom of the balance sheet, we need to insert a line that says non-controlling interest that amounts to 20% of the outstanding equity of Nissan. So that's $6,800 to account for that 20%. Same way with the income statement, A plus B equals C until we get down to net income attributable to non-controlling interest, which is posted right below net income. That's 20% of the outstanding net income in Nissan. That's a deduction to net income. So now we're able to report the net income attributable to Penman shareholders. And this is the number that we used in Module 3 when we were looking at return on equity. When we calculate return on equity, we want to make sure that that's germane and relevant to us as shareholders of Penman. We don't care about the non-controlling interest. So we want that number right there. Any questions on how all of those numbers come together? Okay. Okay. Okay, this one's not too tough. We're complicating it again, but in this instance, the authors basically they go back to the first example. We have 100% consolidation. We don't have minority interest. We have 100% consolidation, but we've paid more than book value. So let's consolidate these two. So we have Penman, we have Nissan, we have A plus B equals C with the same reconciling entries until we get to goodwill, where we have to book an entry for an additional $1,000 to make everything balance. Because Penman paid more than the book value for this. So if we only do the consolidation, we're gonna be $1,000 short of a balance sheet that balances. So we gotta put a plug figure. And the plug figure is goodwill, and we talked about that, and I think it was module 5. When one company A buys company B, we go through and we adjust to the book value, and we try to attribute that to any intangible that we can. So property rights or intellectual property or trademarks or franchises. And when we get to the bottom of this big list of intangibles that could have real value and we've adjusted all that, anything that's left over just becomes a catch-all goodwill number. So that's a little bit of a review of a concept that we've talked about in the past. And we've touched on this in the past too, but I'll refresh your memory. At the end of every accounting cycle, when we do have goodwill on the books, it's our job to ask ourselves the question, is it still worth it? At one point in time, we thought, and or this one was worth, or we paid, and that includes the goodwill. That's where the end of the accounting cycle, we have to ask ourselves the question, is it worth it? Well, the markets change, and if they fundamentally change, we might say to ourselves, well, no, it's not, that we've lost key clients, key suppliers, the global markets change, we have inventory obsolescence, pick a reason, it's not worth it. In which case, we're gonna have to go through an exercise to impair that goodwill, which effectively just writes it down and causes us to take a loss. So this is an example of goodwill, well, impairment charge, that AT&T book to the tune of $4.5 billion. I didn't read the fine print on this, what they book it for, that's a big number. We test our goodwill for impairment at a reporting unit level. Blah, 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 with our annual impairment testing, calculated fair value of the mobility reporting unit exceeded book value. Okay, well, they didn't really give a reason why, they just said it wasn't as valuable anymore. So that's a big red flag. Obvious. At one point in time, AT&T paid something for this business, and now they're saying, well, we paid $4.5 billion more than what we should have paid for that business. That's a $4.5 billion mistake. And management is going to try to convince all of us, everybody reading the fine print at the 10K, they're going to try to convince us that that is no longer a part of ongoing operations. And we've had this conversation several times this semester. Why do we focus on ongoing operations? Because theoretically, a company is worth the present value of its future cash flows. So you see ongoing operations as the focus of all the earnings calls, and analysts, you'll often hear that referred to as econ. And Charlie Munger has a great quote, he's like, every time you hear EBITDA, just substitute the word bullshit, and you'd be much better off as a financial analyst. God, that's so that's the way it goes. It's still one of my favorites because there's so much truth to that. My point is, when you see this, and it's the same management team that overpaid for that business, be very skeptical about doing business with them in the future, because you're doing business with a management team that was wrong in a big, big way. So you need to get comfortable with the notion that they're not going to let that happen again. And you need a compelling reason to believe that.
Don't say it's gone here.
Well, okay, I like the way you think. You're like, this management team makes bad decisions. We should go sell it. That's a good spin. I like it. Now, for a company the size of AT&T, I might be being too hard on them. I don't know what AT&T market cap is, but I would guess it's probably several $100 billion. But this is still a couple % of that market cap, so it's not peanuts. But you do need to kind of keep those things in the proper perspective too. Okay. I mentioned last time we got together that we would take a a deeper dive into some of these concepts that ultimately end up in other consolidated income. So the basement, junk drawer, call it what you want. We're talking about consolidated financials. When you do consolidate financials, you're gonna have to repatriate the earnings of other foreign owned companies. And the company might just go by the same name. Most of the time about Apple, Apple does business all over the world, but they technically have a subsidiary listed in Australia. So it's, I don't know, Apple Ltd or whatever it is, it's domiciled in Australia, it's registered in Australia, it's technically a separate company, but it's all part of the mothership. So that has to get consolidated in the same way that we're consolidating these other businesses. But the added wrinkle when we consolidate a multinational company is that not all in US dollars. So we're gonna have to take Australian dollars and figure out how we report those on, I guess, a US dollar denominated balance. If that will- that's all or not. So the way that works is we're gonna get to the end of the year, we're gonna look at the assets reported in Australian dollars, and we're just gonna translate them back at an exchange rate. And that exchange rate is almost guaranteed to be different than what the exchange rate was the year before when we translated all those dollars. And as that exchange rate changes, it's gonna cause us to book a gain or loss. Exchange rates are very volatile, which is the reason why we put their gain or loss in other comprehensive income. More often than not, they're gonna offset themselves over time. Doesn't always work that way, but it sure is nice when it does, because it makes the good folks at the Financial Accounting Standards Board look pretty smart for ruling that this is an item that belongs in other comprehensive income. So let's look at an example. Assume a European subsidiary has no changes in its balance sheet during the year. So we have subsidiary A. Their assets in 2021 were 2,000 euros, left-hand column. That translated into $2,500 in 2021. Okay, fast forward 1 year, they have the identical assets they had in the prior year, and that shows up identically as 2,000 euros right there in the December 2022 column. But this year we see that the dollar per euro has fallen from $1.25 to $1.10, which means that when we translate that, we now have $2,200, resulting in a loss of what looks like $225. Yes. So that is posted to other comprehensive income and becomes the cumulative translation adjustment. And when we're dealing with multinational companies, that cumulative translation adjustment can be tens, if not hundreds of billions of dollars. Find out what that is for the companies that you're doing the research project on, because it might be mean. I mean, we're in a period of time with these tariffs that has led the US dollar into what could very well be a secular decline. That's exactly what we had. The US dollar is on the way down, and that's the example that our authors just gave us. And if you think that's permanent or semi-permanent state of being, then the assumption that I threw out there, that because currency is so volatile, these gains and losses balance out over time, that assumption no longer holds. If that's the position that you want to take, then some of these multinationals that have more of their more and or less of their dollars to repatriate, they might be worthy of betting either for or against. So it would be the other way around, I guess. You would want a declining dollar results in a loss, but it works the other way around if you're repatriating dollars into euros. So you might look for a business that's domiciled in Germany or UK or like, so hindsight's 2020, right? Doesn't really have as much to do with translation costs, but if you're looking for businesses domiciled in Europe right now, the sector that has done so well this year are European defense contracts.
matter that anything to do with the war in Ukraine, right? So that's political too, so Trump's taking the position that they should be shoring more of the bill for their own defense. And, that has caused many countries in Europe to significantly increase the amount of spending in the annual budget, and that has helped European defense contractors to take up. So if you know that, and you have a position on the dollar, both of those forces might be combining to put some winds in the sails of European companies.
We think with like a weaker dollar too, that will increase like exports from America to Europe or kind of thing if it's
You know, normally it would, but with the trade wars, I don't know that I can confidently say that as much anymore, but it's gonna be dependent on the individual trade or negotiations.
But that's an astute observation. Okay, 45. This is a key conceptual slide as it pertains to consolidated reporting. So just recognize the limitations of what we're trying to do here. And I thought this bulleted list was really pretty good. If you're thinking about shortcomings, this would be a common, like on the CFA exam, be a lot of questions like this. They want to do what's not the shortcomings of the particular valuation technique or accounting methodology. So for consolidated accounting, we need to know that the cash that you consolidate is not always available to the individual subsidiaries. And that can get you in trouble when you do your liquidity analysis. So you're consolidating two, or sometimes it feels like you can't cups because you might have 20 or 30 variable interest entities all coming up to holding. Don't be fooled. The lawyers are very smart. They're going to make sure that legally all those entities have their own borrowing agreements with banks and other creditors, and that those borrowing agreements don't add any risk to the parent. So typically the way these things are structured is that those borrowing agreements are linked to collateral at the consolidated end, at the variable interest end, which means that variable interest entity doesn't necessarily have access to the cash of the mothership. If they did have access to the cash of the mothership, then their creditors would also have access to that cash, and they could come try to claw that. So they would no longer be able to pursue bankruptcy as a means of remedy when and if that ever arose. So the way most of these conglomerates kind of organize themselves is, you know, let's put cash at risk. Let's put cash at risk globally and make it a bunch of investments. So let's protect ourselves to the extent that we possibly can. If 1 or 2 or 5 or 10 of them go bad, we want to be able to declare bankruptcy, wash our hands, and keep everything else moving along as efficiently as we can possibly move along. So that's the common misconception that consolidated accounting indicates or is relevant of a business that's functioning as one, not as clean as that.
So like comparing something, to the bottom right into the lower companies, if like the bank's interest rate is super high, and huge file tax on that. But then they have a private loan for the smaller.
Yeah, they absolutely can, and you're gonna have a bunch of attorneys involved to draft that loan to make sure that it's not adding any more risk to the consolidated parent company. So now we're in legal territory. I just know that it does get, the fine print gets very particular to make sure that you're not allowing any of the creditors of the subsidiary to be able to pierce that corporate veil or come up and hold the holding company liable.
There's one, very like the parent company, one of their subsidiaries with smaller companies who like your well, the one well, I'm not sure, I heard how to sell them off at a lot, but
Oh, yeah, that's business, yes, and yes. It's only when an unforeseen event comes around and is something, that book $4.5 billion loss, right? And you want to get stuff like that, make sure it stays down at the whole, or the subsidiary. And you let that little stepchild go. Sometimes that can make sense as the CEO. Other limitations, consolidated balance sheets are a mix of various subsidiaries. Consolidated disclosures are highly aggregated. So just the level of complexity there in general. And it's beyond the scope of this class for you to dig into the fine print associated with all of the variable interest entities. Just know that they are each protected by their own corporate structure. Okay, I want to go to 52, talk a little bit about derivatives. Last week, we talked about the accounting for derivatives, and there's some more terminology here. Okay. Okay, let's talk briefly about hedging. Okay, let's just look at this example slide of different types of risks that these companies might get. Tiffany & Co. So we're talking about diamond rings, silver, gold, platinum. Tiffany & Co. has an incentive to want to hedge out their costs associated with those raw materials. So they probably have a very, very good understanding of how much gold they're going to use and sell on an annual basis. And they may have a very good understanding of the risk associated with that. So the price of gold has gone from $1,500 an ounce to $6,000 an ounce in the last 7 years. Well, that's a big time increase in just basic supply for Tiffany. And they may say to themselves, we're not willing to introduce that level of volatility into our business. So we don't hedge that. We know gold costs $1,500 a day. We're gonna enter into futures contracts so that next year we're basically buying it at the same price. And we're gonna do that every year. So they're all the volatility, uncertainty, and risk out of the business. Michael Kors, they have exchange rate risk. So if you're buying inventory from around the world, different currencies, you need to make sure that you have access to that currency and you don't want to bear the currency fluctuations between time A and time B. You can help that out. Harley Davidson, commodities to make motorcycles, so aluminum futures, Southwest Airlines, jet fuel, Cisco Systems, equity investment values, Verizon, variable interest debt. These are all examples of exposures that companies maintain, and simple access to the options market or futures market or hedging vehicles allow them to control that level of risk. And typically the way that works is when you enter into a hedge, you call it an options contract against Southwest Airlines jet fuel. Well, you're gonna buy a call or a put on jet fuel, so if you need to buy 10,000 gallons of jet fuel, and the price of jet fuel doubles, you're gonna enter into a hedging contract that also doubles in price. So you're gonna jet fuel doubles in price, and then you gotta go buy that, which would normally result in twice as much spend or huge loss, but the value of your hedging went up commensurate by the exact same value. So you're even Steven, so to speak. That's the basic concept of hedging. What we need to concern ourselves with is when you enter into a hedge and you subsequently have to book that huge gain or huge loss that you knew you were going to incur, because that's what hedges do. They result in a gain or loss, and that gain or loss is designed to offset your exposure perfectly. You still end up with a huge gain or a huge loss on your books. So how does the accounting work for that? Well, the answer to that, like everything else, It depends. There's two classifications of hedging vehicles. So the first we have, the hedging is a fair value hedge. Okay, if we have an asset. Example that our authors give us is Cisco hedges the marketable securities on its balance sheet. I don't know what kind of marketable securities Cisco has on its balance sheet, but let's say it has a bunch of bonds. So they own them, so that would be a long position in certain bonds. To hedge that, you could take a short position in the same bonds. So now it doesn't matter if they go up or down, your hedge position is going to deliver the exact opposite return, and you're going to have basically a 0% increase or 0% loss in the value of those marketable securities. That's called a fair value hedge. Okay, contrast that against a cash flow hedge. So with a cash flow hedge, we're going to use the example of Tiffany. They don't currently own the gold or silver, but they know they're going to need to buy it next year. So because they don't currently own it, we call it a cash flow hedge, because they're going to have to send cash out to them. And by entering into this hedged vehicle, they can forecast how much cash they're going to deploy when purchasing those raw materials with near certainty. So the hedge allows them to forecast and basically say, okay, next year we know we're going to be able to buy a ton of gold at this price. That's what the forward contract does for a company like Tiffany. And that's called future cash flow hedge. Okay, one of them is going to flow directly into income. The other one is going to flow directly into other comprehensive income. Any guesses as to which one is which? The fair value flows through to net income because we already own the asset. The future cash flow hedge flows through to other comprehensive income because this is speculative. It's about the future. We don't own that asset. So these are good examples. Tiffany really does buy gold, silver, and platinum every year, and they have a reason to hedge with things, probably do so with near certainty. So the gain or loss that we book to other comprehensive income, so they do a pretty good job of offsetting what we actually spend. But at any point in time, they could say, well, we're not interested in hedging anymore, we're interested in speculation, and they could go buy jet fuel, or they could buy orange juice, or they could buy some other hedging instrument. So this is deemed as speculation or falls underneath the category of speculation, or the word that I like to focus on is future. Nobody has a crystal ball, we can't predict the future, so we're gonna put that underneath other comprehensive income because it can be wildly speculative. And so fair value will flow through a current income, cash flow hedges will flow through other comprehensive income. And let's see. And that's all I wanted to say on derivatives. Okay. And then I wanted to touch on page 62. The last earnings objective in this chapter that I wanted to comment on tonight was on equity carve outs. So this is company A decides that there's a part of their business that they want to sell. And you can sell that directly to the client. You don't have to find a buyer for it. So if we all own ABC Co. and we have a little subsidiary business that ABC Co. owns, we can just say, well, we're going to spin that off. Now, what does that mean? Imagine you have a Fidelity account, it's your brokerage account, you log in today and you see ABC Co. pays you $10 per share. Tomorrow, you would log into that Fidelity account and you can see ABC Co., which you owned yesterday is at $10 a share. Now you see ABC Co. $9 a year. But you also see XYZ code, $1 a year. So your account was worth $10 yesterday, it's worth $10 today, but now you have two holdings inside of your account. You have ABC code, which had XYZ code as a subsidiary yesterday, they just spun that off into new stuff. Now ABC code, they don't know that stuff anymore, it just shows up on your brokerage account the next day, that's called a spin-off. Spin-offs are one of the most attractive segments of the market problem. Now, why would that be? There are certain dynamics at work when company A spins off company B. And the most pronounced effect of the spin-off is when you have a very large company spinning off a very small company. Because most investors, especially most retail investors, are not paying attention on a day-to-day basis to what's going on. Any of you ever heard of Kenvue? Any of you ever heard of Johnson & Johnson? Okay. Now, last year, yes, last year, Johnson & Johnson spun off this little company called Kenvue. Kenvue owns Tyler. Okay. Well, that's exactly what happened. When retail investors around the world logged into their Fidelity account one day, they saw Johnson & Johnson. When they logged into their Fidelity account on the next day, they saw Johnson & Johnson and Kenvue. Everybody had the same responsibility. What Kenvue? I've never heard of it. When they have a new name. Now everybody knows Tylenol, but a lot of people didn't bother to do digging and understand, okay, what's Tylenol, who's the management team, how good is this company? All the questions we've been asking ourselves all semester. So what do? Well, you just sell it. That creates forced selling pressure that doesn't have anything to do with the true fundamental underlying economics of the company. What happens? Well, when investors in mass sell stock, the price drops. Okay, now imagine you're a large cap manager for American Century or Buffalo Fund or you run a large cap mutual fund. Today you're in Johnson & Johnson, tomorrow you're in Johnson & Johnson and Kenny. Well, it's not in your chart to hold small cap stock. The investors that own your mutual fund, they chose to invest with you because you manage large cap stocks. You manage that portion of their 401k account. You manage that portion of their endowment. And sometimes these are huge institutional investors. So you don't have a choice. You just have to sell Kenvue immediately. No choice. The combination of those and other forces when you have a spin-off very frequently drives the price of that spin-off down to levels that are unjustified. And that dynamic usually takes place over 4 to 12 weeks. And you can watch the price of that spin-off just decline. And if you step in and just indiscriminately buy all spin-offs about 2 months after they spin off, that universe of stocks, last time I looked at the research, it had outperformed the S&P 500 index fund by nearly 11% annually. Pretty good. I don't think the effect is quite that large anymore because it was so pronounced that now you can buy an ETF with the ticker SPIN. So investors are like, oh, that's great. Yes, I want the ETF. So be on the lookout for spin-offs. They can be great places to invest. Split-offs are the exact same thing. Only now the investor has a choice. You're gonna get a mailing, you're gonna open it up, you're gonna say, hey, our mistake, we're gonna split off instead of spin off. Kenvue, or J&J is gonna split off Kenvue. And if you want to participate, just send this piece of paperwork back and we'll get that here. Split offs, as you can imagine, they don't have the same pronounced effect because now all the investors opted in. And I said, yes, I want it. So the example I used of Kenvue, due to a lot of investors that might have been thinking that they were going to get the spin-off back because I was honest, shortly after 5 to 6 months after the spin-off, in fact, Tylenol started getting linked to Office, and so
Kimberly Clark, like today, the rest of the, their stock just tanked for 14% because of it.
Yeah,
I don't know if they just like overpaid for it, or if that's just speculating on the autism. I imagine they got a good deal. If it was being data on it, I'm get rid of it.
yeah, you know, maybe they knew in advance. I don't know.
Pretty good.
But, so that's my lecture tonight, gang. We'll be back again in a week. Exam closes in a week, so. We're good. So, thanks all.
You close Monday night? Like, try to pick it Monday, like during the day?
Yeah, Monday night at 11:59. So. Get it in,
I think the CFP, quiet and stuff,
oh, really?
yeah.
Good luck.
But